Warren Buffett started investing at age 11. By 50, he had accumulated $370 million. Most people stop there and call it a success story. But here is the part that changes everything. That 370 million represents less than 1% of his current net worth. 99% of his wealth was built after his 50th birthday. Same strategy, same stocks. The only thing that changed was time. And what time does to money when you finally stop interrupting it. Millions of people know that story. Buy good assets. Hold them. Let time do the work. And yet almost none of them end up with anything close to his results. Not because the strategy is wrong, because understanding the strategy and knowing how to live through it are two completely different things. So what separates the people who actually stay the course from the ones who don't? 4 numbers: 7, 5, 3, 1. Not a slogan, a framework. A specific set of rules that maps how compounding actually behaves across a full investing lifetime, why it feels broken long before it becomes unstoppable, and what you need to do at each stage to still be in the game when the growth finally hits. My name is Alex, and if you have ever stared at your account and felt like the math should be further along by now, stay with this, because I am going to show you exactly why your balance looks the way it does right now, and how the 7-5-3-1 rule gives you the blueprint to stop guessing and start navigating. Once you understand this framework, you will not just feel more patient. You will know precisely where you are in the compounding curve and what your next move should be. That clarity starts with understanding a paradox that almost nobody warns you about, one that is hardwired into the math of compounding itself. Pay attention to this next part because it is the one thing most investing content gets completely wrong. Compounding is not a reward for patience. It is a mathematical function with a specific shape. And that shape is the reason so many people who do everything right still feel like nothing is working. The curve starts nearly flat. It stays flat for longer than feels reasonable. And then, at some point that is impossible to predict from the inside, it bends sharply upward and everything changes at once. The problem is that most people quit somewhere in the flat part. Think about what the numbers actually look like across a full investing lifetime. Take someone who starts at 25 and invests consistently until 65. 40 years of contributions, 40 years of market returns. If you split that journey into 4 decades and ask how much of the total wealth gets built in each one, the answer is deeply uncomfortable. The first decade produces less than 4% of the final outcome. The second decade adds around 9%. The third pushes further. But the last decade alone, the final 10 years before retirement, accounts for over 60% of everything. 60% in the last 10 years of a 40-year journey. That is not a bug in the system. That is the system. But it does not feel that way from the inside. From the inside, year 3 looks almost identical to year 1. The balance grows slowly. The contributions feel significant relative to the returns they are generating. And the natural human response is to conclude that something must be wrong. Behavioral economists have studied this reaction extensively. They call it exponential growth bias, the tendency to evaluate a non-linear process using linear expectations. You work an hour, you expect an hour's worth of output. You invest $1, you expect roughly $1's worth of visible progress. But compounding does not trade in visible progress during the early years. It trades in base building. Silent, unglamorous, essential base building that makes everything that comes later possible. A simple illustration makes this concrete. Picture a single water lily that doubles in size every day. On day 10, it is still tiny. On day 20, you might notice it if you were looking for it. The pond does not reach half coverage until day 47. And then in the final 24 hours, it covers the remaining half entirely. 46 days of almost nothing. 1 day of everything. Your investment account is that pond. Consider a nurse named Patricia who starts investing $350 a month at age 28 into a broad market index fund. By 32, she has contributed around $16,800. Her balance sits at just under $19,000, less than $2,000 in returns over 4 years of consistent investing. She starts wondering if the strategy makes sense. A colleague tells her about a real estate syndication returning 12% annually. The index fund suddenly feels inadequate. What Patricia cannot see from inside year 4 is where she actually is on the curve. She is in the flat section. The base is being built. The math is working exactly as designed. Switching strategies at this moment does not feel like panic. It feels like a rational upgrade. That is what makes it dangerous. Warren Buffett is the clearest proof of what staying in the flat section actually produces. By his 50th birthday, he was already one of the most successful investors in American history, and yet 99% of his net worth was accumulated after that point. The snowball he spent decades rolling finally reached the slope where gravity took over. That is the compounding paradox. The process feels broken precisely when it is working, and surviving that feeling long enough to reach the inflection point requires something most investors never build deliberately. It requires a minimum time horizon, and that is exactly what the number 7 is designed to give you. 7 is not a lucky number. It is not arbitrary, and it was not chosen because it sounds clean in a framework. 7 years is the point where the historical data stops being theoretical and starts being evidence, and that distinction matters more than most investors ever appreciate. Here is what the evidence actually shows. If you take any 7-year window in S&P 500 history, that is the 500 largest publicly traded companies in the United States, and ask how often a diversified investor made money over that stretch, the answer is 95% of the time. Not in cherry-picked periods, not in ideal conditions. Across every 7-year window, including the ones that started right before a major crash, the Great Recession, the dot-com collapse, the 2022 rate shock, hold for 7 years, and the odds are overwhelmingly in your favor. That number does something important. It converts patience from a feeling into a strategy. Think about what most new investors are actually doing in years 1 through 3. They are running on faith. They have read that the market goes up over time. They believe it intellectually, but they have no personal evidence yet. Every month feels like a test of a thesis they cannot fully verify. And that is an uncomfortable place to make decisions from, because faith, under enough pressure, tends to bend. 7 years change that dynamic. It gives you a finish line that is specific enough to hold on to. Not, I will stay invested for the long term, which is vague enough to mean almost anything when the market drops 15%. But I will not evaluate this decision until 7 years have passed, which is concrete enough to actually defend against panic. Consider a pharmacist named Kevin, who starts investing at 31. He put $450 a month into a broad market index fund in early 2017. By 2020, his portfolio had grown steadily and then dropped hard during the market crash in March, 34% in 33 days. His balance falls from around $72,000 to just under $48,000. 3 years of contributions were partially erased in a matter of weeks. Kevin does not sell, not because he is unusually disciplined, because he made a specific commitment before he started. He told himself he would not make any strategic decisions about this money until 2024 at the earliest. 7 years. By the time that date arrives, his portfolio has recovered, pushed through new highs, and sits at just over $190,000. The crash that felt catastrophic in the middle of it is now a barely visible dip on a chart trending sharply upward. That is what 7 years actually buys, not just returns, evidence. Personal, lived, undeniable evidence that the process works, which makes every subsequent year easier to hold through than the ones before it. There is also a subtler benefit that rarely gets mentioned. A 7-year minimum horizon changes how you relate to market volatility in real time. A 10% drop in year 2 of a 7-year commitment feels like a setback. The same drop in year 1 of an open-ended, long-term plan can feel like a verdict. The time frame reframes the event. So in how you interpret volatility determines whether you stay invested or make the kind of reactive decision that locks in a loss and resets the clock entirely. 7 years is the entry fee. It is the minimum commitment that gives compounding enough runway to show you something real. But a long runway only helps if the portfolio on that runway is built to last. Staying invested through turbulence is significantly easier when your portfolio is not overexposed to any single risk. And that is exactly what the number 5 is designed to protect against. Ask most investors what diversification means, and they will tell you it means not putting all your eggs in one basket. That is technically correct and practically incomplete, because you can own 20 different stocks, spread across 20 different companies, and still lose 40% of your portfolio value in a single bad quarter if those 20 companies all move in the same direction when the market gets scared. Quantity is not protection. Structure is. This is the distinction the number 5 is built around. Not how many positions you hold, how many fundamentally different jobs is your portfolio doing at the same time. A portfolio built on 5 pillars does not just grow in good conditions. It survives bad ones. And survival, as the previous section established, is the prerequisite for everything. You cannot benefit from a 7-year time horizon if your portfolio shakes you out in year 3. The 5 pillars are what make the 7 years actually livable. The first pillar is your core growth engine. This is a broad market index fund, something that tracks the total US stock market. For the S&P 500, as of early 2026, the S&P 500 has delivered an average annual return of approximately 10% over the past 3 decades when dividends are included. This pillar does the majority of the compounding work over time. It is not exciting. It is not supposed to be. Its job is to capture the long-term upward drift of the American economy and do it cheaply without requiring you to pick winners. The second pillar is dividend-paying stocks. And these are companies with a track record of distributing a portion of their earnings to shareholders on a regular schedule, quarterly in most cases. The dividend yield on the S&P 500 currently sits around 1.3%, but dedicated dividend funds and individual dividend stocks often yield between 3 and 5% annually. In a flat or declining market, those distributions keep cash flowing into your account. That cash gets reinvested. And reinvested dividends are one of the quietest compounding accelerators most investors overlook entirely. The third pillar is small cap exposure. Smaller companies carry more volatility. They swing harder in downturns and recover faster in upswings. But over long horizons, they have historically outpaced large cap returns by a meaningful margin. More importantly, they tend to move on different cycles than the large companies that dominate the first pillar. When big tech struggles, small domestic manufacturers might not. That differentiation is the point. The fourth pillar is international stocks. This is the pillar most US investors skip, and the omission is significant. Concentrating entirely in the American market means your portfolio rises and falls with a single country's economic conditions, interest rate decisions, and political climate. Broad international exposure across both developed and emerging markets adds insulation that becomes very visible during periods of domestic turbulence. It also captures growth in economies that are expanding faster than the United States in certain cycles. The fifth pillar is defensive assets, bonds, treasury funds, or similar instruments that do not grow aggressively, but hold their value when equities fall hard. Think of this pillar not as a drag on performance, but as a stabilizer. When the market drops 20% and your portfolio drops 12%, you are statistically far less likely to panic and sell. That gap, 12 versus 20, is the difference between staying invested through the correction and locking in a loss you spend years recovering from. A house built on one pillar falls the moment that pillar is stressed. A house built on 5 can absorb a hit from almost any direction and stay standing. That is the goal. Not a portfolio that performs brilliantly in ideal conditions. A portfolio that keeps you in the game through every condition. Because staying in the game is the only way the 7-year clock ever reaches 0. And yet even the most carefully constructed portfolio cannot protect you from the force that quietly destroys more long-term wealth than any market crash ever has. That threat is internal, it runs on emotion, and it arrives in 3 distinct stages that every long-term investor walks through without exception, which is exactly what the number 3 is designed to help you navigate. Here is something the financial industry almost never admits. The biggest threat to your long-term returns is not inflation. It is not fees. It is not even a bad market. It is a perfectly ordinary Tuesday afternoon when your portfolio is down 8%, your conviction is low, and you make a decision that feels completely rational in the moment and costs you a decade of progress. Emotions are not a side effect of investing. They are the central variable, and the investors who understand this do not try to eliminate their emotional responses. They map them out in advance because the sequence is predictable enough to prepare for. There are 3 stages. Every long-term investor passes through all of them. The order rarely changes. The first is disappointment. It arrives earlier than expected, and usually somewhere in the first 18 months. An electrical engineer named Thomas starts contributing $400 a month at age 32. He sets up the automatic transfer, selects a diversified portfolio across 5 asset classes, and feels good about the decision. 14 months later, he sits down to review his account. He has contributed $5,600. His balance shows $6,340, less than $800 in returns after more than a year of consistent investing. That number is not wrong. That is exactly what early compounding looks like from the inside. But it does not feel that way. It feels like the strategy is underperforming. It feels like something should be happening faster. And in that gap between expectation and reality, the first doubts take root. Thomas starts reading about alternative strategies. He opens a few tabs. He does not quit yet, but the seed is planted. The second stage is frustration. This one arrives with evidence, which makes it harder to dismiss. A friend mentions she turned $6,000 into $18,000, trading a small cap biotech stock over 8 months. A finance account Thomas follows online posts a screenshot showing 42% returns in a single quarter. The S&P 500 has a flat year. It happens more often than people remember, and 2022 saw a decline of over 18%. And suddenly, the diversified, patient approach looks pedestrian compared to everything else apparently working around it. This is where comparison does the most damage. Not because the comparisons are accurate, because they feel accurate. And what the screenshots never show is the position that lost 70% before this one. What the friend does not mention is the 3 trades that did not work before the one that did. Survivorship bias is everywhere in investing culture and almost invisible to the people inside it. The investors who held a diversified portfolio through 2022 and into 2023 watched it recover fully and push to new highs by early 2024. Most of the traders chasing alternatives did not have the same outcome. The third stage is panic. This is the most dangerous because it arrives with urgency. A real correction hits, not a dip, a genuine, sustained decline. 15, 20, 25%. The portfolio Thomas spent 2 years building has lost thousands of dollars in a matter of weeks. The financial headlines are catastrophizing. His instinct is screaming that the rational move is to preserve what remains, exit the market, and re-enter once things stabilize. Here is the problem with that instinct. Stabilization almost always happens before it feels safe to re-enter. By the time the panic subsides and the headlines turn positive, the recovery is already well underway. You sold near the bottom. You buy back near the top, and you have permanently converted a temporary paper loss into a real one that compounding cannot recover. Research tracking investor behavior through multiple recent market cycles consistently shows the same pattern. The investors who exit during sharp corrections and wait for clarity before re-entering underperform the investors who simply hold by a margin that compounds dramatically over time. The cost is not just the missed recovery days. It is the psychological reset that makes the next downturn even harder to hold through. The antidote is not discipline in the moment. It is preparation before the moment. Name the 3 stages now, while the market is calm and your thinking is clear. Decide in advance what disappointment will feel like and what you will do when it arrives. Decide what frustration looks like and how you will respond to the comparisons that fuel it. Decide that panic is a stage, not a signal, and that your plan does not change because the headlines do. That preparation is what the number 3 actually gives you, not a guarantee that the feelings will not come, a guarantee that when they do, you already know what they are and what they are not. What they are not is a reason to stop. What they are not is evidence that the framework is broken. What comes next is the final lever that makes the entire framework dramatically more powerful than most investors ever realize, because it turns a good compounding machine into one that is genuinely difficult to stop. Most people set up their investment contributions once and never touch them again. They pick an amount that feels responsible, automate the transfer, and consider that part done. And on the surface, that logic is reasonable. Consistency matters. Showing up every month matters. But there is a quiet flaw built into a fixed contribution that slowly widens the gap between the investor who understands this and the one who does not. That flaw is inertia, and it costs more than almost any other single variable in the compounding equation. Here is the mechanism. Inflation in the United States has averaged roughly 3.1% annually over the past decade. What that means in practice is that a fixed monthly contribution loses purchasing power every single year. The number in your automatic transfer stays the same, but that number does less work relative to your actual financial life with every year that passes. You are not falling behind dramatically. You are falling behind invisibly. And invisible is the most dangerous way to lose ground. The fix is one decision made once a year. Increase your contribution by 10%, not 10% of your salary, 10% of whatever you are currently contributing. If you're putting in $400 a month in year 1, You move to 440 in year 2, 484 in year 3. The individual step is small enough that most people genuinely do not feel it in their monthly budget. The cumulative effect over 30 years is anything but small. Here is what the math actually looks like. A marketing director named Sophie starts investing at age 28. She contributes $500 a month into a diversified portfolio, returning an average of 7% annually. She keeps that contribution flat for 30 years. By age 58, she has accumulated just over $1,100,000. That is a real outcome, a meaningful one. Most Americans retire with significantly less. Now meet her colleague David. Same age, same fund, same 7% average annual return, same $500 a month to start. But every January, David increases his contribution by 10%. In year 2, he is contributing $550. By year 5, he is just over $730 a month. By year 10, he crosses $1,100. By year 15, he is contributing just under $1,800 a month, an amount that no longer feels like a stretch because his salary has grown alongside it. At age 58, David's portfolio sits at just over $3.1 million. Same starting point, same investments, same market conditions. A difference of just under $2 million, generated entirely by one small automated decision, executed consistently once a year. $2 million is an abstraction until you translate it. At a conservative 4% annual withdrawal rate, that gap produces $80,000 per year in additional income, every year, for the rest of their lives. That is not a rounding error. That is the difference between a retirement that requires careful management and one that offers genuine latitude. There is also something worth noting about how the 10% increase feels over time. In year 1, it is a minor adjustment. In year 5, it is barely noticeable against salary growth. By year 15, it is happening automatically, and the amount feels proportionate to a financial life that has expanded alongside it. The sacrifice required to make each increase gets smaller over time, while the impact gets larger. That asymmetry is the entire point. This is also the moment where all 4 numbers in the framework begin working together simultaneously. The 7-year horizon keeps the pressure off. The 5 pillars keep the portfolio stable through turbulence. The awareness of 3 emotional stages keeps you from sabotaging it at the wrong moment. And the annual 10% increase turns a solid plan into one that compounds on itself, in a way a fixed contribution simply cannot match. Put all 4 numbers together and the results stop looking like math. They start looking like the difference between 2 completely different lives at retirement. Here's what this video was really about. Not a 4-number rule, not a portfolio strategy. It was about understanding why compounding feels broken before it works, and why that feeling is the most predictable, most misunderstood part of the entire process. A few things are worth keeping close. The slow early years are not a malfunction. They are the mechanism. Behavior determines outcomes more than asset selection ever will. A portfolio built to survive is worth more than one built to impress. And the investor who increases their contribution by 10% a year will quietly outpace almost everyone who earns more, but adjusts nothing. Next time you check your balance and feel behind, ask yourself which stage you are actually in. Disappointment, frustration, and panic are not signs to exit. They are checkpoints on a predictable map. Knowing where you are changes what you do next. There is one question this video did not answer. Knowing the framework is one thing, but where exactly do you put the money? Which specific accounts, in which order, at which stage of your career? Give the framework its best possible chance of working? That is a different map entirely, and it is worth drawing carefully. If this gave you a clearer picture of how the machine actually works, subscribe, because that is exactly the kind of question we answer here.